Good evening, guys. A very warm good evening to all of you. So let's wait for a while. Let's wait so that others can join as well. And then we will start. No, the class is not started yet. We are waiting for others to join. And in the next 1 minute, we are going to start. We will be starting with monetary and fiscal policy. But before that, we have a short topic to complete, and that is about types of market structure. So welcome, guys. Welcome, all of you. Let us start with the session and continue our discussion on basics of economics. The topic that we are going to discuss for today, just give me a second. Okay. So the topic that we are going to discuss for today is types of market structures. Basically, there are four types of market structure. First one is monopolistic competition. Second is perfect competition. Let's arrange this in a serial order. I'll tell you why I'm naming first as perfect competition. You will yourself realize in a couple of minutes. First is perfect competition. Second is monopolistic competition. Third one is third one is oligopoly, oligopolistic market or oligopoly. And last and the final one is monopoly. Now, what is perfect competition? which is the most competitive segment or most competitive industry in India? Which is the most competitive industry in India? Think about all the industries, all the products that you use, and which industry. Okay, FMCG, considering that a larger share belongs to an unorganized market. Okay, so perfect competition. Starting our discussion with each of these market structures. There are four types of market structure: perfect competition, monopolistic competition, oligopoly, and monopoly. As we go from A to D, as we go from top to bottom, we are going from highly or highest competitive market, highest competitive sector, to no competition or single firm industry. Where, where in a perfect competition, we have we have highest competition. There are many suppliers, and in monopoly, we have no competition. Okay. So let's start. Let's start our discussion on perfect competition. In a perfectly competitive market, there would be many buyers, many buyers, and many sellers. Many buyers and many sellers. The product in this kind of markets, that is perfectly competitive market, yes, yes, we will come to it. We will come to it here. So guys, if you remember, I had asked you to save your doubts related to the types of market structure. And if I asked you to note down any doubts, just once we are done with this class, once we are done with covering all the types of market structures, just just shoot me your doubts so that we can discuss each and every doubt. The products are the products are extremely identical, extremely identical. What do we mean by this? We mean by this that every supplier and every customer are trading same products between them. Buyer are buying the same product from different sellers, and sellers are selling the same product to different customers. Now, in such a market, what do you think? Who will have the more negotiation power? Who will have the more bargaining power? In such a market, whether customers would have a more bargaining power, or the supplier would have the more bargaining power. The bargaining power will lie in the hands of customers, because products are extremely identical, products are extremely identical, and people will change the preference. People will change the preference if you charge a higher price. People will change the supplier. People will change the business house from where they are procuring goods for. If you are changing the price, they will obviously go for, since the product are extremely identical, they will go for the option that best suits them according to their budget, and they will go with the option with the cheapest availability. So this is common sense, right? If I want to get the same product, I will go to a shopkeeper who gives me the best price for it, and by best price I mean the lowest price for it. Now tell me whether the demand for the product will be completely elastic or inelastic. The demand, no SIM cards and mobile data is not the example of perfect competition. How can supplier offer same products at different prices? So let's suppose GA, I am not saying that they are going to offer the same product at different prices. There are 10 shops in a market next to each other. There are 10 shops in the market. Consider the vegetable market and consider there are 10 shops in the market and each of them are selling the same quality of potatoes. We know, right? One shopkeeper might sell the same product at 10 rupees per kg. Other might sell it for 12 rupees per kg. Other might sell it for 14 rupees per kg. Although the products are extremely identical to each other, the quality of potato is same. So that is why here we are saying that suppliers offer same product. All the suppliers are offering same product and all the customers are buying the same product. GA, have you got this? The demand. Now, what is elastic? Identical means same, exactly same. So if there are two shopkeepers, VK, I and CK, I am I am offering you the same product at 10 rupees and CK is offering you the same product at 8 rupees. You will go with CK, right? Why would you choose me? Because we both are offering you identical products, same product. Okay. Now, what is elastic and inelastic? If if the demand, or I say quantity demand, okay, GA has a doubt over here. I'll come to your doubt, GA. Simply because that the production capacity of that supplier is not enough to fulfill the demands of the whole market. That is why there are many suppliers in the market. So I'll discuss that point, GA. It is very interesting point. I'll come to you. What is price elasticity? So if quantity demand is dependent on the price, quantity demand is dependent on the price, and and quantity demand is highly sensitive to price level. Quantity demand is highly sensitive to price level. What I mean by highly sensitive to price level, if you increase your prices by 1 rupee, your quantity demand will fall by a major chunk. Quantity demand is highly sensitive to price level. Then the sector or the product is tend to be price elastic, then the sector is called price elastic, or the product, particularly the product, is called price elastic. It means that if you are increasing your product's price from 5 rupees and you are seeing that there are more number of customers shifting to your competitors who is offering at a lower rate, in that case, your product is very much dependent on the price level. A little change in your price level can cause a big change in your quantity demand, and that makes your product quite elastic. Now, please try to think of with a mature point of view. There are many buyers. There are many buyers and many sellers, correct? Each of these buyers and sellers are working in this industry, are working in this industry from a long time. And they are managing their expenses in the industry from a very long time. It means that the business is able to sell. If there are many buyers, it would mean the demand of the product or the volume demand is very high. The volume demand is very high. Why? Because how can we infer that? Because there are many buyers in the market. Similarly, there are many sellers in the market as well. So supply volume is also high, so that market can reach to its equilibrium. Supply volume is also high. Can you see this? The demand volume is high, the supply volume is high. That is why there are many sellers and many buyers in the market. GA has asked the question, if one supplier, if there are, let's suppose 27 suppliers from A to Z, and if one supplier, let's say N, offers the product at the cheapest cost, every customer will go to N. Every customer will go to N to buy the product. Let's suppose N is a market leader. Let's suppose N is a market leader. Being a market leader, he is able to produce the goods at cheapest price. All other 25 people are able to produce the goods at 20 rupees. N is able to produce the good at 16 rupees. That is the reason why N is able to sell the product at the cheapest price. Now GA has a doubt. Everyone clear with the scenario, what is going on? N is the market leader and has all the facilities that is needed to make the product in-house. And that is the reason being N is able to offer the product at cheapest price. GA is saying that if N is offering the product at cheapest price, everyone will go to N. Everyone are going to go to N since products are extremely identical. How would the other 25 firms in the industry would survive? How would they survive? How would the other 25 firms in the industry would survive? The answer is, since there are many buyers and many sellers, you will see that N is not sufficient enough to meet the demand of all the buyers. N is not sufficient enough to meet the demand of all the buyers. If N will sell its product at the cheapest price, if N will sell the same product at the very cheapest price, he will run out of inventory very soon. He will run out of inventory very soon. Are you getting this, guys? Are you getting this? Tell me if you have any doubt in perfect competition. All cheap products are not of good quality, so we move to other buyer. No, you are misunderstanding this point, Surbi. Although you are technically correct, but you are misunderstanding the point because all the products over here are extremely identical. There is no quality difference or product differentiation between the products sold by any two firms. If I go to buy Natraj pen from your shop, or if I go to buy Natraj pen from someone else's shop, it would be same. The quality would be same. Similarly, in a perfectly competitive market, the products that are sold in the market are extremely identical. There is no quality difference between the two products. The prices in this kind of market are merely decided by demand and supply. Demand, this is supply curve. This is demand curve. They will intersect with each other to come to a price level, to come to a price point, and the market will have to accept that price point. The market will have to accept that price point. If you are selling higher than, let's say, P0 is that price point, PO is that price point. If you are selling higher than P0, you will be facing the challenge of obsolete inventory. What is obsolete inventory? You will not able to sell your stock, and you will have a huge chunk of inventory remained in your godown. If you are able to sell at P0, you will be competing against the market. And if you are selling less than P0, you will face a challenge. You will face a challenge of stock out. Same is done by Geo in telecom sector that GA has asked. We will come to GA. We will come to Geo as well as and GA as well. We will come to the analysis what GA actually did. But taking telecom sector as an example of perfect competition won't be the appropriate comparison to make. So let me discuss all the four types of market structure, and then we will go to the discussion of the case studies. No, there are perfectly competitive markets, GA. If you see that commodities market, I am not talking about the exchange traded commodities market, but over the counter commodities market, where copper, zinc, yes, even gold or wheat, rice, in these market, obsolete inventory is the risk of inventory not getting sold. Risk of inventory not getting sold. If N is having the privilege of a market leader, it means that he is making the most profit in the market. So he can extend his inventory to, right? Yeah, but there is extent to everything, right? If the market needs 5 lakh tons of rice, tons of rice, and as a market leader, you are having 15% market share. As a market leader, you are having 15% market share. It means that 15% of this 5 lakhs, that is 150,000. 150,000 is contributed by you. If you stretch yourself, if you take some debt financing, although debt financing won't be preferable over here, I will tell you why. Because you don't have bargaining, you are not having that margin so that you can take debt. Are you understanding? You don't have that margin that you can take debt. So TG is saying N is having the privilege of a market leader. It means he is making the most profit in the market. So he can extend his inventory to right. Yeah, he will be able to extend his inventory. He will be able to increase in market share if he continues to be a market leader in the long run. But in the long run, there would be some other firm like M, L, O, who will also fight for being the market leader, right? So he will have to face the extreme competition over there as well. So he although he could increase his market share, he could not be the one who supplies 100% of the market. That is why perfect competition would have many buyers and many sellers. If there would have been many buyers and only one single seller in, it wouldn't have been a perfectly competitive market, right? It would have been monopoly. Yes, stockbrokers. No, I won't say stockbrokers would be a part of perfect competition. I'll tell you why. I'll tell you why. So if you guys are clear with Priyanka, I'll tell you why stockbrokers are not a part of monopolistic, perfectly competitive market. When I'll discuss monopolistic competition, that is the next part. To offer products at the same price, then how are customers getting bargaining power? Let's say all the suppliers have mutually agreed to offer products at same price. Then how are the customers getting bargaining power? Now, very important point, very good GA. I am really glad that all of you are brainstorming about this. GA is saying that all the all the suppliers in the market have created a platform and decided a one single price. All the suppliers in the market are creating a platform and determining one single price. Based on that, how the customers have bargaining power. Anyone think about this? Very good. How the customers in that case would have bargaining powers. Firstly, there are many suppliers, many sellers in the market. There are many buyers as well as many sellers. Is it possible? Is it possible to determine or to make a single platform between between 5,000 suppliers? Can 5,000 people agree to vote on a single consensus? Can 5,000 people agree for a single price? The answer is no. More the number of suppliers, more challenging it is to create a platform between the suppliers of the industry. Apart from it, even if it is possible, they won't agree to each other. Why? Because all these firms are competitors to each other, guys. Please remember, all these firms are competitors to each other, and it is very much difficult for these 5,000 people to come together and come to a single price point. Why? Because each of these firms might have different production cost. Each of these firms might have different production cost, and based on that production cost, they will try to find an equilibrium price. Are you getting this? GA, have you got it? It is although possible in case of industry where are only two or three firms. It is possible for two and three people to agree at a single price, but it is not possible for many suppliers to agree at a single price. Please try to understand. Correct. Yes, PJ, you are correct. Shall we move on to the next part? Shall we move on to the next type of market structure? If you guys allow me to. Next is perfectly competitive market. I'm sorry, perfectly competitive market is something that we are done with. Next is monopolistic competition. Next is monopolistic competition. Again, in a monopolistic competition as well, there are many firms in an industry, same like perfect competition, same like perfect competition. But one thing that distinguishes monopolistic competition from perfect competition is that there is little product differentiation. There is little product differentiation. Now, the best example for this, as someone said, in perfectly competition would be the stock broking apps. There are multiple stockbrokers in India, and there are multiple discount brokers in India as well, traditional as well as digital. So there is Motilal Oswal, there is IFL Securities, there is Zerodha, Upstocks, Angel One, Grow, and there are every bank has their own stock broking app. There is a bank for Yes Bank has its own stock broking app, Axis, Kotak. Every bank has its own stock broking app. So there are multiple options available with the consumer. Yes, there are lots of small players as well. There is 5paisa, and all of them come together to make up the market for stockbroking in India. Now, each of these are not offering the same product. Although they are offering the same product, they are offering the same platform. The user interface, they are offering the platform. The industry is same, the sector is same. They are offering their respective platforms so that you can buy or sell securities. Some of and each of these people have their different product differentiation. A USP for Zerodha, maybe you can gift shares to your loved ones. Whereas Grow can cater those people who need small brokerages, who love small brokerages. Upstocks, on the other hand, may provide fast service. Paytm Money may provide you with accurate recommendations for buy and sell. So each of these people are, although more or less offering same type of product, the product is not exactly identical. Each of them has their own app, their own user interface, and their own unique selling propositions. Now tell me guys, one thing that I guess you missed about both perfect competition and monopolistic competition. Will entry and exit in a market like monopolistic competition or perfect competition would be easy or difficult? Would entering into this kind of market would be easy or difficult? entering into this kind of market would be easy or difficult? There are many suppliers. And what is the reason there are many suppliers? Because everyone can enter this market. Entry and both exit from this kind of market is very easy in case of both monopolistic competition and perfect competition. Both entry and exit in this kind of a market is very easy. Are you getting this, guys? Why it would be easy? See, the characteristic of the market that there are many suppliers and many buyers. You will not have to hunt for buyers. There are no limit for buyers. You will not have to hunt for your customers. You can just open your shop and customers will reach out to you because there are many customers in the market. A right marketing campaign can get you your way. And since already there are many buyers, there is no unique selling proposition in their product or very slight unique selling proposition in their product. So entering into this kind of a market is very easy. Now, tell me guys, in a monopolistic competition, will the firm and the competitors in the market enjoy the pricing power? Will the firm and the competitors in the market enjoy the pricing power? The question that you should ask is, sir, the pricing power with respect to what? The answer is they will enjoy more pricing power, more pricing power as compared to as compared to a firm in as compared to a firm in mono as compared to a firm in perfectly competitive market, as compared to a firm in a monopolistic firm would enjoy more pricing power as compared to a firm in perfectly competitive market. I will prove my point. Just give me a second. A little bit more pricing power than someone in a perfectly competitive market. Let's say, let's say, for example, that, for example, that you are going to open a demat account and you have multiple options available with you. You have A, B, C, up till 100 options available with you. Now, if there are 4 players that you have shortlisted, let's say Zerodha, Upstocks, Angel One, and Grow. You have shortlisted these 4 players. Zerodha charges 20 rupees per order. Upstock charges 19 rupees per order. Angel One charges 18 rupees per order. And Grow charges 17 rupees per order. Now you have to make a decision that where are you going to invest? Where are you going to open the demat account? And through which platform are you going to invest? So considering the some of you, Ritik is saying that he will invest in Grow. Let's consider this is for equity segment, and you are opening just for equity segment, ignoring FN. or let's say for equity, FNO and all, the prices are same. For both equity and derivatives, the prices are same. So Zerodha is offering you 20 rupees per order. Upstock is asking you 19 rupees. Angel One 18 rupees. Zerodha is saying, although I am asking the highest price band on your list, I have the highest facilities available. I have shares transfer. I have I have an infra. I have an infrastructure which gives you the speed, the most speed, most, the most, which gives you the most execution speed of your order. They have such such multiple differentiation, which makes it a better platform. Correct? They have multiple differentiation, slightly better than any of these three, which makes Zerodha a better platform. You as an investor or an analyst or an investment banker are managing your clients 50 crore worth of capital or 50,000 million of capital. As an investment banker, you have an asset under management of worth 50,000 crores. So for 3 rupees, will you risk the corpus of 50,000 crore or 50,000 million or 500 million? For 3 rupees, you will always go for a better execution platform, right? And why Zerodha was able to take 3 rupees more out of you? Why Zerodha enjoyed a slightly higher pricing power? Because he is offering a slightly better product differentiation. Why? Because it is offering a slightly better product differentiation. And if the product differentiation is not better, let's say that both Zerodha and Upstocks, let's say both Zerodha and Upstocks has same, let's say both Zerodha and Upstocks has same policies, everything same, each and everything same. Like in case of a perfect competition, will you be paying 3 rupees more? Will you be paying 3 rupees more? No. If everything is same, why would you pay 3 rupees more? That is why in a perfectly competitive market, enjoying the pricing power is not something in the supplier's hand. Second thing, if if Zerodha only has 1 point more favorable as compared to Upstocks or Grow. If Zerodha just has one single point more favorable as compared to Grow, will you be paying 10 rupees extra for that one single product differentiation? If it won't matter you much, will you be paying 10 rupees, 20 rupees, 15 rupees more? No. So there is slightly product differentiation. There is slight product differentiation. The product are not exactly identical, but similar. Slight product differentiation where the products are not extremely identical, but yes, they are similar. So if you have similar product, the prices should be similar, right? You can pay 1 rupees more or 2 rupees more per order or 3 rupees more, considering you are going to execute thousands of order in a given financial year. But Zerodha can't just go like getting 50 rupees more for a given order. So although the pricing power lies with the firm, but the pricing power is very much less. It is more as compared to a perfectly competitive market, but it enjoys a very slight pricing power. So it has some control over the prices. The firm has a bit of control over the prices. Everyone clear with this? Everyone clear with the second part, that is monopolistic competition? Any doubts? Any point of view that you wish to discuss about, we are welcome to discuss it. Have a brainstorming over it. Please think of any point of view that we didn't discuss, and we would be happy to discuss it. Moving ahead, moving ahead, we have a market structure called oligopoly. Yes, Anand ji, tell me. Yes, yes, different colors of umbrella and different types of woods could be an example of perfectly competitive market. Sorry, monopolistic competitive market. Yes, Anand sir, please tell me that in this part, what do you want to know about? In which part do you want me to repeat? Sir, which part in monopolistic competition do you want me to repeat? Please let me know. Which point do you want me to repeat? AK sir, please let me know if you want me to repeat anything. Any example of perfectly competitive market? Vegetable market. If you go to APMC market, where where the vegetables are sold by the wholesalers, you will see that each of the vegetables are procured from similar farms or same farmers. Each of the vegetable is procured from same farmers, and they are selling under same quality and same prices. Prices are determined based on demand and supply. So let's suppose that you want to sell 500 kgs, and you are seeing that based on the demand today, I will only be able to sell 200 kgs. Based on the demand, I am still just able to sell 200 kgs. And if you want to push your product to your customers, you have to offload 300 kgs more. What you would do, you would reduce the prices. You would reduce the prices, and the customers of your competitors will come to you in that case, and based on that you will determine the price. So prices in a perfectly competitive market or a monopolistic competition is based on a cost price plus normal profit margin. It is cost price plus normal profit margin considering your transportation expense and other operating expenses. Done? Everyone done? Shall we start with oligopoly? In an oligopoly market, in an oligopoly market, we have limited number of firms. Limited number of firms. But the number of firms should be greater than one. The number of firms in the market should be greater than one. The number of firms in the market should be greater than one. Because if the number of firms is equals to one, if the number of firms is equals to one, then the market would no longer be an oligopoly, it would be a monopoly market. Yes, telecom market in India is an oligopoly market. Telecom market in India has turned out to be an oligopoly market, and Can anyone guess the reason why some of the industries and some of the sectors, not only in India but across the world, are oligopoly? Although there are higher profit margins in those industries, not many people can enter those industries. Why? We have discussed this point in this class itself. So tell me why. Simply because entry and exit in this kind of a market is very difficult. This kind of market comes with a high setup cost. The firms in this kind of market has high setup cost. So it is not possible for everyone. Yes, AK sir. Yes, because entry cost is very high. Very true. That is why, that is why oligopoly market, oligopoly market has very limited firms. Can you give me another example of oligopoly market? Yes, shipping agencies. Okay. Like most large scale shipping and transportation agencies. Okay. Steel manufacturing. Diamond stores. There are many diamond stores. If you see, Surat is a market of diamond stores. Aviation. Yes. Aviation is a oligopoly market. Oil refineries are, aviation is airlines. Aviation and airlines are same. So aviation is an oligopoly market. Oil refinery, fuel and energy market. Apart from that, automobiles are an oligopoly market. Here there is high differentiation between the product. Yes, pharma you can say, but no, pharma won't be the oligopoly market. It would be a monopolistic market. It depends on the type of drug in pharma you are talking about. So if you're talking about such a drug which only one company sells, then that market is an oligopoly market. Overall, pharma as a sector is not an oligopolistic market. It is more often a monopoly market. Please differentiate perfect competition with oligopoly market. Sure. In perfect competition, yes, AH, you are correct. In perfect competition, the didn't had suppliers didn't had any pricing powers. In an oligopoly, suppliers do enjoy pricing power. I'll give you an example. Suppliers do enjoy. FMCG would most likely be a monopolistic market again because there are many firms in an FMCG market. Suppliers do enjoy a pricing power. Let me tell you why. Does Vistara and Air India, although owned by Tata Group, both are owned by Tata Group, does Vistara and Air India sell their products at same price? Vistara targets premium audience, which USP is comfort and luxury. On the other hand, mobile manufacturing, yeah, can be an oligopoly market. But a small segment of mobile manufacturing, which belongs to a very little price range, like there is a huge competition in that market as well, still it can be considered as an oligopoly market. Whereas Air India targets affordable journeys, affordable commute, So the target audience of these two people are are uh, are very much different from each other, and that is why offering premium services, differentiating the services and the products of Vistara from the all the other aviation companies of India makes it a premium brand, and that is why they charge premium prices in exchange for it. That is why they charge premium prices in exchange for it. So the products are exactly same. The products have somewhat, although they are similar, but with a high product differentiation. If the products are not similar, guys, they won't belong to a same industry. Please try to understand this. If products are not similar, then the industry, you cannot compare a medical producing firm with a juice producing firm, right? So paint industry, yeah, could be an oligopoly market. So similar, but with high product differentiation. High product differentiation is possible in an oligopoly market, which is not possible in a perfectly competitive market and not possible in a monopolistic market as well. And in a perfect competition, firm does not enjoy a pricing power. Here, the firm is independent to determine their prices. Independent to determine their prices. The price of the price of Vistara won't be determined by what Air India is offering. Or I would say the price of Air India, what they are offering, would have a very little dependence on the price of Vistara because they are targeting a completely different set of customers. So independent to determine the price. And the barriers to entry in a perfectly competitive market is very low. Everyone, it's very easy to enter or exit this kind of a market, while it is very difficult to enter or exit this kind of a market like an oligopoly market. Finally, guys, are you comfortable with oligopoly market? Are you comfortable with oligopoly market? Now, someone said that why LPG prices in India is rising. Why LPG prices in India is rising. The reason being it is LPG is an example of oligopoly market. Gas cylinders and suppliers of gases in India is an example of oligopoly market. So the firms, the firms among themselves, it's easy to coordinate. It's easy to coordinate between the firms and determine a price. Would that be like government markets? No, actually, there are various providers of LPG and CNG in India. Government are not the only one of them. There are different providers for cylinders, and one new company that is not new company, but it has established. It was established long ago. That is one of the company of Adani Group. That is Adani Total Gas, completely privately owned company, no government interference or government stakes, or might be some of my minority stakes of the government. Adani Total Gas supplies CNG through pipelines, supplies CNG through pipelines. And and that is a privately owned company. So that is why the prices of LPG and CNG is rising in India. Now, now similar is the case with the telecom company as well. The telecom sector in India, you saw Jio came with a plan for 9 months providing free internet, and they started rising prices, and now the prices have been rising tremendously. Although India is one of the land with the cheapest internet services, but the prices have comparatively rising every single quarter. Every single quarter the prices are rising since its historical averages. Now now privately government resource company right to help government government to, yes, they do. Now, one of the other reason that could be of an oligopoly market would be or license requirement from government. License required for government. So in some industry, I'm not talking about the telecom sector, but in some industry, government would want government would want small number of firms to be in the market. Small number of firms in some industry, government would itself want small number of firms to be in market. Can any one of you think of the reason why? So so what I'm saying is, in some of the firms, yes, no PJ, might be data privacy, might be one of the issue, but think in the term of economics, no, supply is not limited. That is not the case. Security, yeah, maybe. But in some of the sectors, government itself wants that there are only few players in the market. Let me give you an example. Electricity. Government has given license for every state and every district that MSCB, Maharashtra State Electric Board, will provide electricity in the given area. Uh, Reliance will provide electricity in the given area. Other government owned institutions might provide electricity in the given area. Why? So government provided licenses for providing the electricity. So NTPC, why government would want that? Why government would want that there are only limited players, that there are only limited players in the market? Why any government would want that to happen? Scarce of resources? No. Yes, TG, you are somewhere close. You are very close to it. Yes, very good, Priyanka. Cost should be effective. Cost should be effective. So I will explain this, guys. I will explain this. Let me just download this file because I am out of sheets. Only 20 slides can be open in a given sheet. So I am out of sheets. Let me just post this. Guys, are sheets available to you in the PDF format? Are these things are the scribbled papers available to you in the PDF format? Perfect. Those who might have joined from the mobile phone might not see the sheets. Apurv, have you joined through the mobile phone? KA, have you joined through the mobile phone? Those who have joined from the mobile phone might not see the sheets. I would request them to get the sheets through LMS. It would be uploaded by Monday or Tuesday. Perfect. Now, what would government want? Government in their manifestos has promised the people. So you will find a section where it says notes, and in notes and PDFs, and there you will be able to find that sheet. Yes, we will take a break for 5 minutes. Let me just get done with this discussion, because out of the curiosity you were asking, when we were discussing basics of economics, you were asking a lot of questions about this. So it is essential to discuss one or two case studies. We will surely be taking a 5 minutes break. Don't worry. Now, government manifestos promised that there would be electricity reach, electricity reach in every society and every house. Correct? Government promised this. This is the responsibility of government to make the electricity available to every house. Am I correct? But if, and also before coming to it, and also the cost of establishing a thermal power plant or a power generation unit, the cost of establishing a power generation unit involves high capex. The cost of establishing a power generation unit involves high capital expenditure. Do you guys agree? Guys, do you agree? Yes, yes, please take care of her. Please take care of her. I hope she get well soon. Now, now, don't you think if there would be many firms in the same area, there would be many firms in the same area, customers would be distributed among these firms? Customers would be distributed among these firms. And if customers are distributed among these firms, tell me, will the will the firms be able to recover this capex? If I am saying that if customers are distributed among these firms, among all of these firms, will the firms be able to recover the capex? And what will they do if they want to recover the capex? They will raise the electricity prices. They will raise the prices of electricity if they want to recover the capex. Is this in the benefit of the citizen? Is this in the benefit of the citizen? No. So some regulations also allows some firms to be in a oligopoly market. Now, now, if there are few firms in the market, if there are few firms in the market, they could charge unnecessary prices, right? They could charge unnecessary prices. Am I correct? If there are, if there are few firms in the market, and one important thing, if in case they want to recover the capex, they will raise the price. In if they want to recover the capex, they will raise the price. And if they have raised the prices unnecessarily, it is not in the benefit of citizen. So what government would do? Government would government would keep a cap, keep a cap to prices. It means that government would say that you cannot raise the price above a certain limit, above a certain limit. Now, if they are not able to recover the capex, if they are not able to recover the capex, if they are not able to, let's say three firms have joined, and if they are not able to recover the capex, will the firm is in the business for making money, right? They are business has an objective of making money for its shareholder, and if they are not going to make money, if they are not able to recover the capex or make money out of it, if they are not going to recover the capex, they will go out of business. They will go out of business. All of them would go out of business, and due to which the infrastructure of a nation would fall. There would be less development in a nation. So what government would do to protect these firms? In that case, what government would do to protect these firms? Government would provide subsidies. Government would provide subsidies to protect these firms. Sorry for the handwriting, guys. Today my hand is little bit paining. That is why I'm not able to write it in a perfect note sense, but you will get the PDF. Don't worry. You will have a written PDF for this. Everyone clear with this? Everyone? Perfect. The PDF, once we are done with the economics part, all the PDFs will be uploaded on the LMS. Once we are done with the economics part, all the PDF will be uploaded on the LMS. So guys, let's take a 5 minute break. Let's take a 5 minutes break, freshen yourself up. And at last, we are going to discuss monopoly. At last, we are going to discuss monopoly. So take few minutes, freshen yourself up. Let's go on a 5 minute break, and then we will discuss. We will resume our discussion on monopoly. So KG, what you can do is you can just go to ask a doubt section. You can mention the reason of your doubt about the placements and all about the internships or placement, whatever you wish to raise the doubt for. And then you can go to raise a ticket. This is how you will find when you will log into the LMS, you will find a section where it says ask a doubt over here. So just go to that and you will find that issue resolved. What is CAPEX? CAPEX is capital expenditure. Heavy investment in property, plant, or equipment. So Establishing a power generating company will need a plant, right? And that involves heavy capex. So that why government gives subsidies so that business don't go out of the industry. So let's suppose Reliance, Tata, and Adani. Ambani, Adani, and Tata are there in the business of supplying electricity. If they are not making profit, they will go out of the business, right? Why they would continue operating that business? And if they go out of the business, you won't get electricity in your home because these are the only forms. So in order to motivate them to do business and in order to give the electricity to the consumers at a lesser rate, they usually offer subsidies. Shall we start, guys? Shall we resume? Guys, if you are back, shall we resume? Okay, DK is back. RJ is back. KK is back. Waiting for more responses, guys. K is back. Perfect. Let's start. Now, in a monopoly, you are the single supplier. You are the single supplier. The supplier enjoys all the pricing power and the products have no close substitutes. So this is also very important, guys. To enjoy the true monopoly, the product should not have a close substitute. For example, you may be a you may be a monopoly business. You may be running a monopoly business of, let's say, tea manufacturing in India. Let's say you are supplying tea and exporting tea to all over the world. You may be running a monopoly business of manufacturing tea and you may be supplying tea to all over the world. But but if your product has a close substitute like coffee, then you won't be able to enjoy the pricing power. Then you won't be able to enjoy the absolute pricing power. So the business in a monopoly have no close substitutes to each other. Apart from that, there are high barriers to entry. Yes, railway in India is in monopoly, but still there are many private players also entering. There are few trains that are privately owned. Like I guess Humsafar Express is the train that is privately owned. High barriers to entry is Google have a competition, GA. Google have a competition, Bing, Yahoo. Although they are not very competitive to Google, but still they are competitors to Google, right? Diamond is an oligopoly market. Diamond can't be a monopoly market. Yeah, military, security, infrastructure, military, defense sectors have many companies under it. So defense sector is not a monopoly market. Military is a military is somewhat related to defense and securities. So military and defense are somewhat different things. If you see that we have a different sector with the name defense sector. Under that we have uh, various various stocks which supplies defense equipments. So that is why military is somewhat different from defense sector, and military is a monopoly, right? Now, here the single seller dominates the market and the firm has significant control over the prices. I'm not sure ITC owns various cigarette brands, but I'm not sure whether it has monopoly or not. There might be some different brands who might be operating along with ITC as well. Although ITC is famous for ITC covers the major market share that I know, but I don't think ITC would be a monopoly business in cigarettes. Yes, ITC owns at 90% market share. That is true, but still there are many small players as well, right? What is Zolgensma? I don't have a good idea about it, Aaron. So businesses have significant control over the prices. They have no DMRC. What is DMRC? Like, I will give you an example. There is one stock listed in stock exchange called Delta Corp, and that is I guess, the only stock related to casinos. They own casinos in Goa, and that is the only listed stock in the Indian stock exchange in casino sector. So that could be a monopoly. Natural gas is an oligopoly business. BHEL has various stocks under its sector, so BHEL is also not a monopoly business, I feel. Now, based on this, we saw that from left to right, that is from perfect competition, monopolistic. Don't get confused between monopolistic and monopoly. Monopolistic, oligopoly. Yes, really in India is perfect competition, monopolistic, oligopoly, and monopoly. We go, yes, Coal India. We go from a perfectly competitive market. Banks are oligopolistic market. IRCTC has monopoly, yes. Even Coal India, I guess, has monopoly. But there are various unorganized sectors, unorganized businesses who deals in coal. I have one of my friend who has a family businesses of coal. I don't know what they are actually into, but I guess there are unorganized sectors in coal as well. So from left to right, we are moving from perfectly competitive market, higher competition to no competition. Now, now we are done with types of market structure. Types of market structure. We will be starting with economy, industry, and company analysis. Economy, industry, and company analysis. But since we are done with types of market structure, take a couple of minutes, think about everything that has been happened till now in economics. If you have any doubt about it, you can mention that doubt in the chat box. We will try to have a discussion over it. And if not, then we will be starting with the next topic, that is economy, industry, and company analysis. Meanwhile, I am sharing the PDF with you as well. Sure, I'll share that. Although for today's class, I have already shared the PDFs, but still I'll share it. Let me just delete all these drawings. The PDF is available in the chat box. If you have joined through mobile, you might not be seeing it, but it will be uploaded on the LMS. Example of monopolistic market: restaurant business, clothes business, juice centers, that is the part of restaurant business, and stationaries is an example of monopolistic market. Pen, paper, notebooks. So all those questions that could pop up in your mind can be asked during placements. Example of perfectly competitive market. In perfect competition, I said we have vegetable market, we have vegetable market, then commodities market, gold market for gold biscuits and all. Then in perfectly competitive market, we can have metal market where or steel. No, steel won't be the perfectly competitive market. Food items, yes. Food items could be perfectly competitive market. Like differentiation between monopoly and monopolistic competition. Monopoly deal has only one single firm. Monopolistic market, clothing, yes. Textile market, textile wholesale market is a example of monopolistic. Perfectly competitive market. Differentiate between which type of question interviewer can ask from this. They can ask that give examples for how. So one question that interviewer can ask is that AR is asking us is differentiate between monopoly and monopolistic market. So monopoly has one single firm. The firm in monopolies has the highest pricing power. It has the control. It has the control over prices. There are no close substitute to the products in a monopoly market. Whereas when we come to a monopolistic market, there are little differentiation among the products in the same industry. Apart from that, the firms enjoy a very less pricing power, but slightly higher pricing power as compared to a perfectly competitive market. There is high competition between the firms. The prices are highly elastic as well. So this is how you differentiate monopoly and monopolistic market. Yes, SB, the PDF won't be available in the video recording. It will be uploaded on the notes section. So over there you can see that PDF. So elasticity is the effect on demand, effect of quantity demand if you change the price. So let's suppose if you are increasing your price, let's suppose PJ, if you are increasing your price, if you are increasing your price, let's say medicine. If there is a medicine for some of the disease, and the company, let's say Lupin is the only company who is manufacturing that medicine. No matter if the prices of that price, Lupin increase the price of that medicine or decrease the price of that medicine. It doesn't matter whether Lupin increase the price of that medicine or decrease the price of that medicine. That medicine would still be in demand. Lupin won't have much effect to its demand by increasing or decreasing the prices of that medicine. It's not that if it decrease the prices of that medicine, which only Lupin manufacturers for a particular disease, they are going to face high demand, and it is not possible that if they increase the demand, everyone will stop using that product. On the other hand, let's suppose you are taking mineral water, and if Bisleri increases the prices of mineral water from 20 rupees to 30 rupees, you will straight away jump to some other product like Bailey and other product in the same price segment, because we have various close substitutes to it. And when we have close substitutes available, the prices are highly elastic. It means that changes in price will automatically impact the change in demand, will have a high impact on the change in demand. I hope now it is clear, PG. PJ, are we clear? PJ, are we clear? Perfect. Does government interferes in monopoly market if it's privately owned so that no undue benefit can be taken by supplier? Yes, it depends on the market actually. If that if that GA to you need to realize that if the monopolies attain through technological advancements, if they has spent a huge expenditure on research and development of trying to find a loophole through which they can penetrate into a monopoly business, government can't straight away interfere to that particular business. Why? Because that would uh, be against the idea of innovation and entrepreneurship. No one will try to be innovative if government charges on innovation and entrepreneurship. So it depends that what product and what sector is operated in the monopoly. So as you can see, railway is operated by government. Railway, metros, to be very honest, metros in India. So yeah, there is also called duopoly. Duopoly is nothing but one of the part of oligopoly. So metros in Mumbai, if you see, is owned by Reliance. So they have monopoly over it. but government had asked them to set the price which benefits them as well to earn a money, to make some money, and it also to make it affordable for the people to commute. So that is how government interferes into those businesses. Duopoly, in duopoly there are two firms. So why government is backing up Vodafone Idea in recent times is because Vodafone, if Vodafone Idea exits the telecom space, uh, there would be duopoly among the firms, and it would be very much easier for Reliance and Airtel to coordinate with each other and inflate and control the prices of telecom industry. And telecom India being such a huge user of telecom base, with every Indian trying to get connected to internet, it could be a problem for government and their perspective towards uh, innovation in India. So that's why they are resisting themselves for introducing to the telecom sector to a duopoly. Generally, it is said that more than 70% of the market share make it a monopoly. It depends actually that what job profile are you interviewing for. If you are interviewing for a research analyst in economics or something, then they can go for questions with examples. If you are interviewing for a role in financial modeling, then economics is a seldom a part that is touched upon. So it all depends upon what you are interviewing for and which job role you are interviewing. Shall we start with the next topic, that is economy, industry, again hedge fund firms. There are many hedge fund firms. There are no limit to hedge fund firms. So it would be a monopolistic market. Well, it also depends on the economy of which you are comparing the hedge funds of. Now, my dear friends, since you will be turning out to an investment banking role, you will be eligible for an investment banking role in the coming time. If I give you 10,000 crores of capital and I ask you to manage or help the company manage by finding the securities, by finding the securities through which, by finding the securities through which you can invest that money and generate a good return out of it. Which securities will you select? And more or less, which security will you select? How will you hunt for those securities? How will you find those securities that you should be available to invest in? That is not the case, Priyanka. So Priyanka is asking, are there any set number of companies based on which we consider that it is a oligopoly, and after that it would be a monopolistic company, monopolistic competition. So that is not the case. It is not about the number of firms. Let's say if there is 20 number of firms in a given sector, compared to there are five number of firms in the given sector. We can't really say based on this that this is a the 20 firms are a monopolistic competition and five firms in the country will have oligopoly. It also depends on the various other factors as well. It majorly depends on the characteristics of the product that the firm is offering. If this 20 firm, if this 20 firm is catering a huge base, is if this 20 firm is catering a huge base and enjoying pricing powers by and pricing powers are enjoyed by each of these 20 firms, then this would be the part of oligopoly market. This would be the part of oligopoly market. So it depends on the overall characteristics. So GV is saying they will diversify the portfolio. My question on how will You be selecting the securities. We will invest in which will give us good return. But how are you going to determine that which company will give you good return? We are no astrologers, right? We don't know which company are going to give us good return. Okay, got it. AK is doing analysis of the company. Okay, by doing analysis of the company, very good. So by doing analysis of the security, by doing the asset allocation and selecting the securities, based on that, you will be allocating the client's money. Now, when you are doing the analysis, by doing the analysis, there are two types of analysis: technical analysis and fundamental analysis. Technical analysis is generally carried out for short term based on price and volume patterns. Price and volume patterns. On the other hand, technical analysis involves reading of reading of charts. On the other hand, fundamental analysis involves studying companies' fundamentals, involving studying doing ratio analysis, studying the USP of the company, that is unique selling proposition of the companies, understanding the product differentiation, understanding the type of market structure company in, understanding the competitive advantage that the company has, also carrying out the relative analysis. Now, while doing fundamental analysis, we as an research analyst are going to focus on fundamental analyst and not technical analyst, because technical analysis are done by traders. Technical analysis are done by traders, and we are looking ourselves to be an analyst, and we are following a long-term perspective. So when it comes to doing fundamental analysis, there are two basic approaches to it. One is called a top-down approach. A says it is a top-down approach. B is a bottoms-up approach. Bottoms up approach. In approach A, that is top-down approach, we go from top to bottom. In approach B, we go from bottom to top. I'll tell you how. In top-down approach, first of all, we select an economy. That which economy are you going to invest in? Where are you going to invest your money? You can invest your client's money in USA, UK, Canada, United, Germany, France, Hong Kong, China, anywhere, India. Whether you are going to invest your client money in an emerging market or a developed market economy, that is first what you will select. Then, if you have finalized that you are going to invest in USA, which sector in USA are you targeting? So industry, economy, industry. Once you have finalized the industry, out of that industry, which is the best companies? Which are the best companies in which you are going to invest? So economy, industry, and company. This is what the top-down approach is. Investing right from top to bottom. The analysis starts from top and moving to the bottom. Yes, Eva, say. AK, tell me how can I help you? You have raised the hand. If you want to mention anything in the chat box, you can. Next is the bottoms up approach, where first you will select the company then you will see that then you will analyze the industry. Guys, is my voice not clearly audible? Perfect. AK, probably there is an issue from your end. Please try to rejoin it. First of all, they will select the company. Then they will go for industry and see whether it is the right time. I have selected this company, but whether it is the right time to invest in that industry or not. Whether government is coming out with some or the other regulation to invest, whether the government, sorry, for that, I'm sorry, DB, whether the government going to interfere or come out with some new rules or regulation into that industry or not. For same example, I would say there was a company Delta Corp. It had a monopoly in its industry, but government came up with a regulation related to fantasy gaming and casinos, due to which due to which this particular stock witnessed of 50 to 70% correction within a week. This stock witnessed a 50 to 70% correction within a week. So first, although the company that I have chosen is strong, also the company that I have chosen is strong. My voice is echoing. Just give me a second, guys. A couple of people, CK is saying that you're not clearly audible in between. Just give me a second. Just give me a second. Guys, is it any better now? Perfect. Perfect. So I have selected a company, but that is not sufficient enough. I need to analyze whether it is the right time to invest in that particular industry or not. Why? Because I found out a company with a monopoly business, that is Delta Corp, in fantasy, in casinos. In casinos, Delta Corp had a monopoly business. In casinos, Delta Corp had a monopoly business. But there was one regulation in the industry, one regulation in the industry that was passed, and due to which the stock prices the stock prices corrected by 50 to 70% within a week. So understanding the industry is also very important. Understanding the industry is also very important, as long as it is important to understand the security. It is as important as understanding the security or the business of the company as it is important to understand the industry. And similarly, it is also important to understand the economy as well. If people are not spending in the economy is in recession. I don't know, to be very honest, although they have some strong fundamentals, but I don't know whether Delta Crop will grow in future or not. And it depends. It depends on the most of the all the major things, whether they win the litigation or not. Or some litigation is going on between them and the government. The verdicts are still to be finalized, and based on that, you will see what happens to the stock prices. Now, it is also essential to understand the economy. If people are not spending in the economy, if economy is in recession, or is in a recessionary gap, businesses will not be able to generate revenue. If businesses are not able to generate the top line or revenue, for that matter, they won't be able to make good profits out of it. And if businesses are not able to make good profits out of it, they the people will short the stocks, right? If businesses are making losses or making less profits as compared to previous years, why would anyone be invested in that stock? They would sell those stocks and go away. Now, to understand about the company, we have annual reports, we have conference calls made by the analyst, between the analyst and the management of the company. You can read that, you can read the business models of the company, you can see what are the future outlook for the company. Based on that, based on industry, we saw that there are different types of market structure. You can try to classify that under which market structure with this industry is going to be part of. So we will see that what are the things that we are going to see while analyzing each of these headings: economy, industry, and company. What about mutual funds investment? We have altogether a different module on mutual funds investment, if you see. So there is a module called asset management and mutual funds. That would probably the module after, if I'm not wrong, that would be the module after uh, economics. And there we will see about mutual funds investments. Yes, yes, we will. We have a whole together module that says financial modeling and valuation. In there, we will go for the in-depth analysis. So we are into valuations and not equity research. So we will having financial modeling and valuations part in the later modules. You have still a month and a half to come to it. Those who are asking about equity research at all. Now, starting with the economy analysis. Within financial analysis, we saw that there is top-down approach and a bottoms-up approach where we need to analyze economy, industry, and company. Starting with the economy analysis. No, this is not the last module. We have still few modules to cover. Yes, we have classes for fiscal and monetary policies next week. So in economic analysis, we have microeconomy and macroeconomy. Microeconomy and macroeconomy. Microeconomy deals with individual and businesses. Often people get confused between micro and macro. I remember it like the way that micro comes from microorganisms. Individual and small businesses actually, correct? So micro word comes from microorganisms, which is very minute particles. So individuals and retail investors and small businesses are micro part of the economy. And macro is how government or the whole nation functions in the economic parameters. So we saw that GDP, GNP, inflation rate, unemployment rate, and along with it, so GDP, GNP, inflation, unemployment, all these things we saw, that was part of macroeconomy. Even the topic that we are going to cover in the next week, that is monetary and fiscal policy, will be part of macroeconomy. On the other hand, microeconomic on the other hand, microeconomy deals with spendings related to individuals like GDP per capita, or whether the business is making profit or not. So profitability values of businesses. So that is microeconomic. So based on these two factors, we try to analyze the economy. Based on these two factors, we try to analyze the economy. And once we have finalized that out of the 5 shortlisted countries, yeah, so income statement, balance sheet, cash flow statement related to individual and businesses deals with microeconomy. Again, micro deals with individual and businesses. So financial statements of individual and businesses will deal with microeconomy. Let's suppose you have shortlisted India, Pakistan, China, Germany, Japan for the country in which you will invest your money. And out of that, you have finalized that you have Japan has the more better future prospects. So you are going to invest in Japan. Next, you will search for which industry to invest in Japan. For that, you will analyze the different market structures, different industry, which prospective futures, and try to analyze the market structure of those industries. Try to find the industries with less competition and high profitability. You will see with the regulatory environment of that industry, whether the government interferes or in that industry quite often or not. Yes, micro is narrow in nature, macro is wider in nature. The regulatory environment of that industry. Then you will go for what are the technological trends and competitive advantage among the firms in that industry. Finally, finally, if you feel that everything suits uh, according to your risk appetite and return expectations, you will see that how the industry is based on its supply chain, which factors are influenced for the supply chain. Yes, there is pestle analysis, that is also we will see there is Porter's 5 forces model, that is also that we are going to see. So supply chain, and along with supply chain, what geopolitical factors are company based, the supply chain of the company is determined on. For example, for example, the petroleum industry in India is based on the crude oil imports from the Gulf, crude oil imports from the Gulf. So whether India have good relation with the Gulf or not, all these things, uh, how how is the how does the future prospects and relations looks between uh, India and Gulf, considering the geopolitical tension going on between Russia, Ukraine, and other major countries of the world, where there is a possibility that is outseen that that the world could lead towards the third world war. So all these things, all these analysis you will make, and based on that you will finalize an industry. So we will continue from industry part where, and exactly which part we will continue is, we will continue in the next lecture from Porter's 5 forces model. Before finalizing the industry or the company, you will do SWOT analysis, strength, weakness, opportunity, threat related to a company or industry, and based on that you are going to finalize the security. So that was all it for the day, guys. I hope you enjoyed the session. Let me just share the sheet with you. EIC analysis. So yes, yes, I have shared the sheet with you on the chat box. Just go through that sheet. Those who have joined from the mobile phone, don't worry. The sheet will be uploaded on the LMS and you can have access to it. Yes, CK, tell me. Yes, Chandanji, tell me, how can I help you? Yes, yesterday's class sheet you want. Just give me a second. Mhm. The date for yesterday was, I think economics will be concluded by the next class. Shared the sheet with you. Shared yesterday's class sheet with you. I hope you got this. In LMS, there would be a section named as notes and PDF, or there would be a section with name economics. And in that economics section, you will be able to find the sheet. Okay, so that was very interesting having an interaction with you guys. Maybe probably because I'm born and brought up in Maharashtra, G. Sorry, yaar. Thank you guys. Thanks a lot. Thanks a lot. Bye bye. Take care. Have fun.